Debt can make someone richer or destroy their finances. The difference is not the loan itself. The difference is what that borrowed money buys. A phone, vacation, or expensive car usually takes money from your future. But a productive asset can create cash flow, grow in value, and help repay the loan. That is how debt can become a tool instead of a trap. Not every wealthy person uses debt. And debt does not magically create wealth. Debt is leverage. It can increase the upside, but it can also magnify losses. The smart question is never, can I borrow this money? The smart question is, will this borrowed money buy something that produces more value than it costs? Before any wealthy investor borrows, the numbers need to survive real life. The asset's income must cover interest, loan payments, maintenance, taxes, insurance, and slow months. If the deal only works when everything goes perfectly, it is not smart debt. It is a gamble wearing a business suit. The first way is rental real estate. Instead of paying the full price of a building in cash, an investor may use a mortgage to control a much larger property. The goal is not simply to own a building. The goal is for rent collected after expenses to support the debt and leave cash flow behind. But smart investors do not pretend rent is pure profit. Vacancy, repairs, insurance, property taxes, and bad tenants can all hit the numbers. Rental income is taxable, and qualifying rental expenses may be deductible under tax rules, but deductions do not rescue a bad deal. Cash flow after all costs is what matters. The second way is using debt to buy productive equipment. Think of a bakery buying a bigger oven, a contractor buying a truck, a manufacturer buying a machine that makes more products every day. The debt is not the investment. The machine, truck, or equipment is the investment because it can help create revenue. The equipment only becomes smart debt when it produces enough extra profit to cover its payment. More sales are not enough. The business needs enough margin after payroll, materials, maintenance, and interest. Many small businesses borrow for growth. The winners measure whether that growth actually pays for itself. SBA programs recognize equipment and machinery as potential business loan uses, but borrowers still need a reasonable ability to repay. The third way is inventory and working capital. A business may need to buy products before customers buy them. A store may need holiday inventory. A wholesaler may need to fill a large order. Used carefully, short-term borrowing can help a business buy inventory, sell it, collect cash, and repay the loan. This strategy only works when inventory moves quickly. If products sit on shelves, interest keeps running while cash stays trapped. That is why experienced owners watch sales speed, profit margin, and customer demand, not just exciting revenue projections. Working capital programs can support businesses that borrow against accounts receivable or inventory, but the reports and repayment capacity matter. The fourth way is value-add debt. An investor might borrow to improve an underperforming rental property, repair a neglected storefront, or upgrade a business location. The goal is to create a better asset, not just spend money on decoration. A meaningful upgrade can improve rent, revenue, customer demand, or resale value. Value-add debt needs brutal honesty. Add the renovation cost. Add interest. Add delays. Add unexpected repairs. Then ask whether the upgraded property can realistically produce enough extra income or value. A beautiful renovation that does not improve the numbers is still an expensive mistake. The fifth way is acquiring an existing business. Instead of building from zero, some investors use financing to buy a company that already has customers, employees, systems, and cash flow. The SBA lists changes of ownership among possible 7A loan uses. But buying a business means verifying real financial records, not falling in love with a sales pitch. A smart buyer studies what happens after the purchase. How much cash comes in? What payroll, rent, taxes, and expenses must be paid? What remains for the loan payment? And what remains after that? Revenue sounds exciting, but the loan is repaid by real cash flow, not by a business owner's optimism. The sixth way is more advanced, preserving liquidity. Some experienced investors may use a credit line against assets rather than sell productive investments during a temporary cash need. But this is not beginner debt. Borrowing against investments can appear convenient, yet it creates serious risk if the collateral falls in value. With securities-backed credit, a market drop can trigger a maintenance call. The lender may demand more collateral or repayment quickly. If you cannot provide it, investments can be sold for you. That is why wealthy investors who use these tools usually focus heavily on collateral, cash reserves, and downside risk, not just access to more money. Most people do not use debt to buy productive assets. They use it to buy things that lose value quickly. Luxury cars, phones, vacations, designer items. These purchases may feel good today, but they do not create income to pay the debt tomorrow. That is consumption debt, not wealth-building debt. Before borrowing, run a stress test. What happens if rates rise? What happens if rent drops? What happens if sales slow down? Could you still make the payment during several difficult months? Lenders often look at debt-to-income measures, but your own test should be even more conservative than the minimum a lender accepts. Smart debt needs a safety net. Keep reserves. Know the difference between fixed and variable payments. Protect the asset. Understand the loan terms. And know your exit plan before you borrow. Can you refinance? Sell the asset? Reduce costs? Or keep making payments when the unexpected happens? Debt becomes dangerous when there is no second plan. Before using debt, ask 6 questions. Does this asset create income? Can that income cover every cost? What happens in the worst month? Do I understand the interest rate and loan terms? Do I have reserves? And do I have an exit plan? If you cannot answer these clearly, you are not ready to borrow. The 6 ways are simple. Use debt for rental cash flow, productive equipment, fast-moving inventory, asset improvements, existing business acquisitions, or carefully manage liquidity. But remember the real lesson. Debt is not the wealth strategy. The productive asset is the wealth strategy. Debt only accelerates a plan that already makes sense. Use debt to buy something that pays you, not something that makes you pay forever. Comment below, which is more dangerous, debt for lifestyle or debt without a backup plan?